All right, good morning and welcome to the weekly market note with Main Management. This is for the week ended August 15th, 2025. On the performance side of things, as you can see, mostly green across the board, or in our case, blue, because that's one of our colors. But very few things in the red on the week. It was industrials, staples, and utilities down, and commodities down for the broad indexes. At the full year level, kind of year to date, I guess. Still energy and healthcare lagging.
Yeah.
They're making up a little bit of ground, getting back towards positive. Energy is down just 0.1%. And then on the right, you can see there, again, resoundingly positive numbers across the board with Europe. International really still leading the way. Europe's up a staggering 27%. It's, continues its outperformance relative to the US.
You saw some interesting kind of reversal maybe not reversal, but kind of change in momentum in the small cap world. That obviously led the way last week. And then also healthcare. It's been a perpetual laggard so far year to date. And last week was one of the second week where it's been actually ahead of the pack. So that's something we're
2 or 3 weeks ago, it posted its best weekly return at that point, and this is now better than that. It was 3.5, and this is now 4.6. So you're starting to see some kind of rotation, I guess, maybe is a way to look at it. But it's interesting because healthcare is traditionally more defensive, and small caps are definitely more cyclical. So the breadth is I would argue a good thing here, that you're seeing kind of a sharing of the wealth, so to speak.
There were a couple of days last week where you kind of looked at the like size style heat map, and that large growth was most negative, and then it was like small value was like the most positive.
So it's interesting to see kind of the shifting in the dynamics here.
On
the recession dashboard, not much has changed. Still, kind of steady as she goes on the blue side. That's just continued from last week, no changes. On the macro data, last week was a big week for PPI, CPI, inflation in general. CPI, the consumer price index, came in at plus 0.2% month over month. That was right in line with forecasts. Core was up 0.3, also in line with forecasts. Interestingly, core, that was the highest reading since January this year. And they both ticked up on a year-over-year basis. Headline is now at 273, and core is at 305. And that's also kind of interesting because you saw shelter, food, and energy all decelerate year over year, which is a good thing. But again, those kind of headline numbers are up a little bit higher. So you're seeing a little bit of kind of, I don't know, the basket of items is definitely coming into play here, where it's more of and we'll go into this actually right here, is the goods and services are kind of shifting things. There's been kind of people saying, well, we haven't seen the tariffs coming through inflation yet. And now you're starting to, I think you can say in earnest this month, especially on the left there, that durable goods number was up 0.36%. That was the biggest since January, but you can see it's one of the 3 biggest readings in the last almost 2 years here. And they're now up 1.24% from a year ago. That's the highest since November of 22. So you're seeing signs certainly of tariffs in there. Services as well, a little bit. Services are a little bit harder to kind of calculate because it's not like a defined price of a washing machine. But again, those accelerated to plus 0.33% month over month, and they ticked up to 383 year over year. Just going back to the goods real quick, non-durable goods were down 0.20 and up 0.5. So you're not seeing as much in there at least as far as the price increases go.
One thing that is kind of interesting to me on this inflation report and kind of the next few that we're going to get, if you think of tariffs as a tax, which we've talked about, whether you can kind of think of it as this tax or is it more of an inflationary pressure. As a tax, if someone wants to pay more for a good that they're importing, that money has to come out of somewhere else in their kind of spending budget. So kind of relative to inflation, you'll see certain items increasing, certain items not increasing because of that mix shift in spending budget. It's not the same as like sending out stimulus checks to everyone. That's a different form of inflation where you're actually increasing like the amount of money supply or the amount of discretionary income. But just something to keep an eye on kind of within the headline number. There'll be pieces moving around, whether it's durable goods or services, and how they kind of interact with each other.
Yeah, definitely. And you can see that on the PPI as well. This was well above forecasts. And it was both overall and core were up basically 0.9% month over month. Forecasts were for 0.2, so this is like 4 or 5x what people were anticipating. And those are the biggest monthly increases since March of 2022. And they both saw, solid accelerations on the year over year. Overall PPI is now up 3.3 and core is up 3.7, basically, if you round. Generally, the way it's looked is PPI kind of feeds through into CPI readings. So we'll see if these kind of start to show up in the CPI readings more in more places and more in the headline than we have this week. And this is a little complication for the Fed because after in the kind of the wake of the weak non-farm payrolls report recently for July, which would say, hey, you're supposed to cut, or that's kind of way you would tend, because if the economy's slowing, you want to cut rates to spur growth. However, if you're getting hot inflation, then you don't want to cut, you want to hike, and that's how you fight inflation. So they're definitely seeing kind of conflicting forces here, where you're seeing maybe a slowdown in the growth of the economy, at least on the payroll side. We'll see, again, more data points come out, and it's kind of an aggregate. But this inflationary report definitely on the PPI side is not great for kind of the cut case.
We'll also see kind of in Jackson Hole what they have to say, and then ultimately something I was reading this morning is there's another CPI report on September 11th, which is going to be highly watched because that's the week before the FOMC decision. So if some of the tariff inflationary pressures in this PPI report kind of feed through to that CPI, you could see some contentious decision making in terms of the September,
especially given that we've
meeting.
already had a couple of dissensions around the rate decisions in the last two meetings. So it certainly is more challenging for the Fed. Within the PPI reading, we got, we highlight here services. Services were much bigger of the overall PPI driver relative to goods. They were up 1.1, which again, the highest since March 22. Year over year, they're now up 4%. And then on the good side of things, on the right, we look at food specifically, and that rebounded. It was a big driver as well, rising 4% month over month. It was almost 40% up in fresh and dry vegetables, which again, this just kind of goes to show you how many underlying line items there are in both CPI, PPI, and that you can really get super granular for a long time. Bacon was the hot topic, and people talking about milk and eggs. Sorry, not eggs, bacon, eggs were the hot topic. So you can see that they really can parse into these very specifically. But it's kind of worth noting that food. And that's something that people, really kind of respond to. They see it daily in the grocery stores, but that's now up 4.2 year over year. And it's kind of maybe back in that uptrend that we saw beginning back at the end of 2023. We'll see if this resumes. But again, kind of some outsized moves on the monthly basis for CPI and PPI. At the end of the week, we got retail sales. This was pretty closely watched as well for, for obvious reasons, the sign of the consumer and the strength. And they were up as a solid 0.5% for overall retail sales. Core were up 0.2. We also saw June revised higher for both of those. So that's a good thing. The consumer spending is kind of consistently chugging along for the last couple of months here. There was a little bit of hand wringing after that, the week, May reading, where it was down. But I think this kind of definitely helped allay concerns about a consumer slowdown.
I'm curious on this piece. I saw a few different kind of conflicting reads on it. Retail sales are nominal, so not inflation adjusted. Some people were saying, oh, it was only strong because of higher inflation during the month. Others said, well, no, it actually was strong. I don't know what you read, or if there's any.
I think it's
saw there.
Not a ton. I think it's, again, you've got people on both sides, and it kind of they will pick the data to fit their rhetoric. So if they're like, we want good consumer strength, great, we'll look at the nominal number, and if we want to kind of downplay this reading, then we'll look at the inflation or the fact that it is not inflation adjusted, and kind of pick and see what you. I don't know. I'll take this at face value and say it's it's clearly more good than bad. And that's kind of the way we look at it. Again, we've said this many times, but we don't rely on just one reading. But you got to start somewhere. And as you can see there on the left, there are two solid monthly readings in a row. That year over year figure on the right, they're up 4.5%. So pretty much in line with historical norms. Just kind of chugging along as far as they're concerned within the categories. And again, this is kind of another way to skin the cat. But month over month, you see autos and furniture up a lot. And again, those are often tied to tariff-related import stuff, autos especially. And so kind of once you see a decline in uncertainty around these tariffs and people are a little bit more comfortable with knowing what they're going to get, or if there's tariffs that maybe they've already been put on and they're like, all right, great, there's not going to be a big change, then they get a little more confident and they go out and spend in these areas. On the laggard, on the month over month, you saw materials and miscellaneous stores. And then year over year, funny enough, you have miscellaneous stores leading to the upside and non-store retailers. So that's like e-commerce. Is a lot of that. No surprise there. And then on the downside for year over year, building materials and gas stations. And again, gas stations is a lot on pricing as opposed to volume, if that makes sense, because that tied to oil prices. For industrial production, we got a decline for both industrial production and manufacturing output. June was revised up, which is a good thing. But this report was kind of just, I don't know, fell a little flat for lack of a better term. The 6-month averages continue to accelerate, which is a good thing. And you're seeing a little bit of kind of, I don't know, a narrowing of the readings. They're not quite as extreme as they were. You kind of got some like big swings earlier in the last 7-8 months, and the last couple have been more kind of muted, I guess. But the year-over-year figures, as you can see there, are accelerating. Industrial production's up 1.4 and manufacturing's up 1.6. For manufacturing output, that's the highest since October of 22. So, you know, again, forest through the trees, where it's kind of good to see these slowly grinding higher. But on the left, you see capacity utilization that was down. It was kind of forecasted to be down. But again, you know, it's not great to see this thing kind of in what looks like a longer term downtrend over the last couple of years. But also, you know, it was in that downtrend pre-COVID and things were humming right along. So I think it's, you know, it's a data point.
It's a small data point on in terms of the overall economy, a relatively small part of the economy. So it's more something structural to watch within industrial production rather than a like critical indicator. I do want to mention that the high tech components, that's something we've been watching for months, actually almost probably years now, where so much of the economy has been driven by these AI data center buildouts. There's kind of been a lot of narrative around this in terms of how much money is being poured into essentially building out these massive data centers, and you can see that on the right there, how much those high-tech kind of categories are hooking up and continuing to move higher.
Yeah, semiconductors especially are up 16.2. That's their strongest since May of 2021. So this is continuing. You're also interesting seeing a little bit of a bifurcation here, where there's computer and kind of you know, certain categories are kind of flattening out and others are accelerating. And it's really computer and peripheral equipment and semiconductors are driving higher, while the others, again, they're still up 5, 6, 7% year over year. So it's solid gains, but they're not accelerating in the same manner. But again, basically positive across the board for that high tech component as spend continues to be driven. On the small business optimism side or sentiment, the NFIB kind of unexpectedly improved, which is a good thing. It's back above 100, was above forecast for 98.6 and the best in several months here. So it's good to see that kind of moving higher. The outlook improved with, you've got respondents saying the next 3 months is a good time to expand, and the next 6 months in general business conditions. Most of those are positive. So firms are more optimistic. And I think honestly, this is more of a lift of pessimism than like outright optimism. Just when you've kind of got the tariffs finally in the review mirror and the uncertainty around the economy and what's going to happen, they're finally like, okay, it doesn't really matter what happened. It's now that we can move forward and adjust to the operating environment that we're in. Because you see also like the uncertainty increased a little bit, which is a weird dynamic with the headline increase. But again, that uncertainty, you can see that's clearly like if you want a chartist, you've got like the narrowing on the right there. So it's, you know, it peaked earlier this year and has now since retreated. And then on the right, we've got the single biggest problem, and that's now quality of labor at 21%. And that's basically at its highs since November of 23.
That was surprising to me, given kind of, well, I guess the part of it would be like, what else would it be? Because inflation's obviously collapsed.
Inflation's collapsed,
but kind of given what's going on in the labor market, I think it kind of reflects how, yes, there are a lot of, it's an employer's market for sure in the labor market. There is a large amount of kind of openings and people still looking, especially on the lower end of the labor market, people looking for work. But there's kind of a mismatch between what employers are looking for and what
the employees bring to the table.
I know that's been a topic of conversation where there's kind of that mismatch. So people, yes, there are people looking for work, and yes, there are job openings, but those don't align right
Yeah,
now.
exactly. That's been a harder thing is employers want more education,
Yep.
more qualified relative to what the kind of applicant pool has. And then also one last thing on the right, poor sales is now the biggest problem for 11% of firms. That's the most since Feb of 2021. So it's worth keeping an eye on to see if that continues to rise. Not a great dynamic there, but again, it's on its way up. And then finally, we got the preliminary reading for University of Michigan consumer sentiment. That declined to 58.6, well below forecast for a 62 reading. Expectations moved down to 57.2. Current economic conditions fell back to 60.9, basically miss across the board. And then you saw inflation expectations rebound. So 1 year is now up to 4.9, and we were up 4.5 a month ago, and 5 years up to 3.9 from 3.4 a month ago. So, sentiment's clearly still mixed. It kind of depends on who you ask. Consumers maybe not as optimistic. You can see on the left there too. There's just been this kind of structural lower reading, and I think I was seeing something. This also goes back to the actual administration of the survey, where it's used to be on a phone, now it's an internet survey, so people are maybe taking it less seriously, and you're more likely to type in angry comments to an anonymous text box than you are like to speak to somebody on the phone. And I've read something, this was a while ago, but they said they'd kind of looked back and tried to figure out why this has been structurally lower. And I think a big part of it is the survey responses and the way it's administered. And they said that basically the current regime is about 8 points below what it used to be when they were pre-COVID, when they were doing it kind of more on the phone and you have better response rates. So maybe add 8 to these and you get a more apples to apples.
Even if you add 8 though, it's still relatively low. I mean, there's been another kind of topic of conversation on the overall how consumers view things and overall consumer sentiment just post-COVID. It broke a lot of these traditional ways of measuring sentiment. So it's hard to kind of extrapolate or compare to past data, which is just like makes it hard.
Right? It's challenging because you're like, well, we're asking the same questions, but does the medium through which we ask them really make that big of a difference? And it certainly can. I mean, you see, think about Google and Yelp reviews. Like people are much more likely to rant and rave on a 1-star anonymous site than they are to call the business owner and yell at them. And so it's just a different kind of dynamic that we're muddling our way through here. So that's kind of it for the week. I mean, we had a lot of inflation data. The kind of takeaway for the inflation is those were CPI was in line, PPI was much harder than forecasted, and that kind of complicates the Fed's path when you look at potentially a weakening labor market and rising inflation. Not great makes things difficult for the Fed. Retail sales posted solid gains. People are kind of eased a little bit around fears around the weakening consumer. Industrial production and manufacturing output, not great, but again, not terrible. Really, that high-tech production is driving things there. And then on the sentiment side, you have kind of businesses getting more optimistic, consumers getting a little less optimistic. So we'll see there again, kind of more wait and see on the sentiment data. And then this week for the upcoming week here, it's a lot of housing stuff. So we have housing starts and building permits on Tuesday, existing home sales on Thursday, as well as flash PMIs. It's a little bit lighter on the macro data side, but we'll see if there's any sign of relief in that housing market because that thing's been frozen. So that's about it for us. Thank you very much for joining us this week, and hope your week goes well. Thank you.
Thank you.